Hello, everyone, and we're just going to spend about 1.5 to 2 minutes letting people into the room. So welcome, thank you for attending today. Good morning. My name is Linda Griffian. I'm the Education Programs Coordinator with BusinessLink, and thank you for joining us in the webinar today. Always before we begin, someone's got me on speaker? Perfect. Before we begin, we always perform a land acknowledgement. So I'm going to do the land acknowledgement, introduce our speaker, and do a little bit of housekeeping as everyone is joining. So at BusinessLink, we are honored to provide services to all entrepreneurs and specialty services to our immigrant and Indigenous entrepreneurs. We are inclusive in our cultural understanding and awareness of the histories of our country. With that, I'll start this meeting with a land acknowledgement. We want to acknowledge that in the province of Alberta, we are situated on the traditional territories of Treaties 4, 6, 7, 8, and 10, ancestral homeland of diverse First Nations groups, Métis and Indigenous people, whose ancestors have walked this land since time immemorial and whose histories, languages, and cultures continue to influence our vibrant community. We pay respects to the Indigenous people of this land, past, present, and future, while recognizing their cultural heritage, beliefs, and relationship to the land on which we reside. A few housekeeping notes for everyone. We're going to be taking questions and answers at the end of the presentation. We're going to be slotting about 10 to 15 minutes for that. If you have questions throughout and are thinking of questions throughout, you can stick those questions into the Q&A section. So if you look at the bottom of your Zoom screen, you'll see an area that says chat and an area that says Q&A. Please put your questions into Q&A. I'll be inserting a link into the chat box for some handouts that go along with today's presentation. So you'll see that go into our chat box shortly. This presentation will be recorded and will be available for you in 2 to 3 business days to see and access. As well, you'll be receiving a PDF copy of this presentation. Today, Osman Hafiz will be joining us to present Financial Survival for Entrepreneurs. And just a brief introduction for him. He is a finance professional who takes pride in supporting innovative and socially driven organizations throughout Canada. He is currently a finance business partner at Athabasca University, where he contributes to the strategic direction of the organization by providing financial planning, analysis, and decision support services to senior management. He'll be our presenter today, and I'll include his bio in the handouts that you're going to see shortly in the link in the chat box. So without further ado, Osman, if you would like to begin, please take it away.
Thank you very much, Linda, for the introduction. Good morning, everyone. Like Linda introduced me, my name is Osman Hafiz, and I'm a volunteer with CPA Canada Financial Literacy Program. It's a pleasure to be here with you today to talk to you about growing your small business into a SME, which is essentially an acronym for a small and mid-sized enterprise. We have about an hour or so together today, and we will try to make this an interactive session. You should all have a copy of the presentation, which you can use to follow along and take notes. This session is designed to be interactive, so please speak up if you have any questions as we go along. We will also have time at the end of the presentation for questions.
So just a reminder, everyone, in the chat box, you'll see I've welcomed everyone, and there is a link to the handouts and the materials that Osman is referencing. And the Q&A at the bottom is where you can insert your questions, as we don't have an actual way to unmute anyone today.
Thanks, Linda. So please raise your virtual hands if you identify as a small business owner, a medium-sized business owner, a solo entrepreneur, or an operating officer or a finance officer within your organization. And please type in the industry you are part of in the chat box. Okay, so there's a few of you. That's excellent. So this will help with sort of using some relevant examples to illustrate the content. I'm just going to sort of quickly go through. Okay, so narration, voice acting, professional services, municipal services, marketing, lots of diversity in our sectors here, which is excellent. So this session is presented by the Chartered Professional Accountants of Canada, or CPA Canada. CPA stands for Chartered Professional Accountant. CPA Canada is one of the largest accounting organizations in the world, representing more than 217,000 CPAs across the country. Depending on their specific job, CPAs can be responsible for ensuring good financial management. We manage budgets, develop plans and policies that help grow the business. Before we get started, I just want to go over a few logistics. If you have any questions, please raise your hand or drop in the chat box, and we can go through some of those questions during the end of the session. We will try to leave about 15 minutes for Q&A with a hard stop at noon. So we have a lot to cover. Let's get started. We are here today to talk about growing your startup business. Here's what I plan to cover. Sorry, Linda, are you able to see the next PowerPoint slide?
No, I cannot see that you moved forward. Do you have an arrow? Oh, there we are.
I got it. Okay. So please note, we will be covering tax strategies and financing, but it will only be discussed briefly in this presentation. Are there any questions before we move on? Okay. So there are approximately 2.4 million businesses in Canada, and out of which 1.3 million are solo ventures. That is, that there's no employees within that business other than the solo entrepreneur. 611,000 have about 1 to 4 employees. 470 have 5 to 100 employees. About 21,000 have about 100 to 500 employees, and 3,000 have more than 500 employees. According to Statistics Canada, the average earnings of a small business with fewer than 4 employees is about $41,000 per year, which gives you about $789 per week. So why is it important to look at key numbers of your business? Well, accurate and timely bookkeeping and recording is key to good financial management. You will need a good bookkeeper to manage your books and ensure you have all of the records in order before external accountants perform year-end financial audits. If you think a bookkeeper will be useful within your business and relieve your time so that you can focus on growing the business, it is worth the investment. Please ensure you obtain references and ensure the bookkeeper has integrity and credibility. Your financial records should be compared to prior period actuals, budgets, as well as competitor data if it's available. The first account we will discuss, so I'm not sure why this, is revenue, also known as sales. Revenue accounts for amounts that you invoice customers for offering products and services. It excludes GST and provincial sales tax, as well as is net of any discounts and returns. Best practice is to track monthly as well as year-to-date revenue performance. Another area of consideration is whether increased revenue through growth is yielding profits or a netting effect due to increasing comparative expenses. Gross profit, on the other hand, measures how much you make from selling products or services expressed as a percentage of sales. That is, sales less cost of sales equals gross profit. Typically, cost of sales include materials used to manufacture the products and wages incurred to produce such products. If your firm delivers services, consider treating the cost of individuals delivering the client work as the cost of sales. So gross profit would be revenue less the cost of these individuals. Think about lawyers in a law firm providing legal services. Now, expenses are incurred to carry out activities important to sustain your business operations. Each expense is grouped with other similar expenses. As an entrepreneur, you want to make sure the groupings are optimal in a way that you are, able to drill down on various activities that are impacting your profits without getting too lost into the details. Typically, expenses are categorized as operating, administrative, selling, marketing, and depreciation. Think about your personal situation and what expenses would fall under each of these categories in your business. Make sure to understand every number and how the total came about. Your CPA should be able to guide you on how to optimally structure your expense accounts. Now, operating profit, which is also known as earnings before interest and tax, EBIT, helps answer the question, are you making money from the business before the cost of financing it? If you aren't, something has to change or it's not worth continuing. On the other hand, earnings before interest, tax, depreciation, and amortization, EBITDA, is similar to operating profit, but excludes the allocated costs of your fixed or capital assets, like office and computer equipment. Because these costs are an allocation, you don't pay any cash for this expense. And so it's considered a non-cash expense. EBITDA gives you a rough measure of operating cash flow. That is earning based on cash in and outflow. And as current and aspiring entrepreneurs, you know that to run a successful venture, cash is king. So we will wrap up key numbers by discussing net income before tax. This is profits after deducting all expenses from revenue, with the exception of income tax. If your business incurs a negative net income, you are in a loss position and must decide how long can you entertain this loss. If you are incurring a loss, an important decision you will have to make as the entrepreneur is how long you can sustain the business, whether to acquire debt to carry on or cut cord and move on to something else. At times, this is the harsh reality entrepreneurs have to grapple with. Cash management is an important aspect of entrepreneurship and focuses on the movement of cash. It is at the intersection of two important topics, money and accounting. As an owner-manager running a small or medium-sized business, you already know the importance of cash. While your accountant may help you measure net income, you know that cash on hand and readily having access to cash when needed are vital to the success of your business. So cash is at the center of all business activity. You need cash to start and expand the business and cash to run it. The success of a business is defined by whether cash it generates exceeds the cash that it disperses. One of the most important activities entrepreneurs partake in is forecasting sources and uses of cash to factor in how efficiently you need to collect cash through revenue and pay vendors. To help us get a better handle on cash, we use the statement of cash flow to help monitor and review the ins and outs of cash flow. The statement, as shown, is categorized by cash received or paid to sustain operating activities, cash raised or paid through financing activities, and investing activities, each serving as important sources and uses of cash. Another important statement to focus on is statement of financial position, which was previously called the balance sheet. Some of the information that you can obtain from the balance sheet can help you prepare an accounts receivable aging schedule and an accounts payable aging schedule. So what an accounts receivable aging schedule allows you to do is take a look at all of your accounts receivables outstanding by days outstanding. So one bucket could be all outstanding invoices by 30 days. Second bucket could be invoices outstanding by 30 to 60 days, and so on and so forth. These buckets allow you to track aging invoices and follow up with vendors to get paid. Remember, cash is critical for success of your business. The faster you can collect cash, the better off you will be. Accounts payable aging, on the other hand, provides you a list of amounts that you owe to suppliers and is important to track so that you can take advantage of early payment discounts or avoid late payment penalties. Remember, these savings can make a difference between earning a profit or incurring a loss. We're going to talk about key ratios that you need to know and why. These include gross profit margin, operating profit margin, current ratio, quick ratio, also known as asset test or liquidity ratio, accounts receivable turnover, and debt to equity ratio. So let's do some math now. Let's look at some key ratios. First ratio we will discuss is gross profit margin. And remember, gross profit is your revenue minus your cost of goods sold or cost of sales. If you want to turn that into a ratio, you take your gross profit and divide it by revenue, which gives you a percentage of how much revenue is really left to cover the rest of your expenses. The operating profit margin gives you a deeper view and includes rest of the expenses in the margin calculation. By dividing your operating profits by revenue, gives your operating margins, which tells you how much revenue that you have left after paying for operating expenses. An important point to note regarding ratio analyses is not necessarily what the ratio is, but rather how the ratio compares to historical ratios of the business or ratios of comparable businesses. Current ratio is a ratio that shows how liquid your company is. A liquidity ratio measures your company's ability to pay down short-term obligations, ones that are due within 1 year. Typically, you want to have a current ratio that is higher than 1. So the way to calculate the current ratio is by taking your current assets, those assets you intend to realize, that is, your cash, your accounts receivables, inventory, divided by your current liabilities, which you intend to pay within the next 1 year. Accounts payable, wages payable. And again, the desire is to have your current assets higher than your current liabilities. Quick ratio, or known as the asset test ratio, is the subset of the current ratio and excludes from current assets those assets that are less liquid, such as inventory or prepaid expenses, and basically leaves in other more liquid assets such as cash and accounts receivables. And you divide that by your current liabilities, and it provides you a more liquid picture of your business. And the key again is to have a ratio of higher than 1. This ratio is very important for many lenders, in particular financial institutions, as it measures the financial solvency of the business.
One of the things I've done, just for everyone who's attending today, is I have put in a number of links that are sort of sitting hidden with the BDC. So if you go to the BDC website, Business Development Bank of Canada, which is our entrepreneurial bank, what I've done for everyone in the chat box is I've put in some additional resources every time Osman is talking about things like ratios or balance sheets or gross and nets and things like that, just to let everyone know there's some great tools and resources in the back end of BDC. So please click on those links and bookmark those if you're interested. And I put the key ratios in as well, Osman, that the BDC does, because when you're dealing with the bank, which you are, so anyone who's on this particular webinar today should be 1 to 3 years into their business at this stage, working with bookkeepers and accountants to start to do some of this more strategic type of work in their business. If you're doing this kind of work in your business right now, then this is the sort of thing that you're working on in order to gain access to your banker and open up some more financing options for yourself. I can speak to this as I just recently grabbed about $250,000 from BDC. So this was an important piece of the work that we did. This was very important to work with my accountant to do this piece. And it took us quite a bit of time to get my business to the point where I could do this kind of work. So do keep an eye on these particular numbers if you're thinking about financing in particular.
That's great. Thank you, Linda. And we will sort of touch more on the financing aspect later down in the presentation, but some great resources available to you as part of this presentation. So accounts receivable turnover is a really important ratio to monitor. And, as it measures the rate you receive your accounts receivables. Accounts receivables are funds that are owed to your company by customers. The faster you collect those funds, the faster cash comes into your company, the better off you will be. So the accounts receivable ratio is calculated as your net credit sales, which are really your sales less refunds and returns, divided by average accounts receivable, which is an average of about the last 2 years or so. So in our example, you have $200,000 net credit sales divided by $20,000 of accounts receivable, which gives you a rate of 10, which means that you are collecting your accounts receivables 10 times a year. And if you want to equate that into days, you say, well, a year has about 365 days. You collect AR 10 times a year, which basically equates to collecting every 36.5 days. Remember, the higher the ratio, the better it is for you, which means that you're essentially collecting accounts receivable faster in a given year. Debt to equity ratio, this is a solvency ratio. And it shows the degree of leverage in your company, meaning the degree of debt in your company relative to the equity of the company. It's an important ratio for banks. They want to assess your ability to repay, and this is one of the ratios they will look at. The way it's calculated is your total liabilities, amounts that you owe, divided by your equity, the amount that is invested in your company. And in our example, we have $60,000 divided by $100,000, which gives you a ratio of about 0.6. So the lower the ratio, the better it is, because it indicates that you have less debt in your company. So now what we're going to do is try to apply these terms and definitions to real life scenarios. There is a document that was shared with you called the matching game that I would like you to work on. I'll give you about 5 to 10 minutes to complete this task, and then we will take it up. If you have any questions, you may send me a message in the chat box, and I will be happy to assist. And I will put the exercise on the screen here as well.
So we do have a couple questions while we wait.
Sure.
We have one from Matt. What is the difference in general terms between selling and marketing expenses?
Mm-hmm. Yeah, that's a great question. So in a given company, you have a sales team, essentially, folks that are, seeking accounts, reaching out to customers, essentially ensuring that they're sort of the front end staff, the front end function within a business. So, you have a sales team that's reaching out to customers, engaging, calling your customers, providing brochures, marketing materials across the network. That would be your selling. Marketing would be the strategic part of your business. So, developing a marketing plan, looking at which markets to enter, looking at customer trends. And so in my mind, that's really the difference between the sales and the marketing function within a business. Selling it is sort of more the front end function, and marketing is more the back end, the strategic function, the backbone of the business. So both serve very important functions within a business, and there are some fine sort of differences between the two functions.
Totally. Yeah. Think of marketing as lead generation and think of sales as closing the deal. That's
right.
Once you've got that lead, you're closing the deal. Ultimately, they're all an expense. So
that's right.
So that's that. What is the safe debt to equity ratio?
What's a safe debt to equity ratio? I would say it really depends on the type of industry you're in. So some industries, just generally by the nature of them, tend to be more leveraged. So you need more debt. I would say capital intensive industries where you require a lot of construction. So think about, property management companies, think about companies that, construct roads and infrastructure throughout the city. They would require more debt. So a debt to equity ratio would be higher for some of these businesses. Now, if you are in a service oriented business where you don't necessarily require a lot of debt, you're mostly funded either through equity or either through investors sort of injecting capital into the business, then you would have a lower debt to equity ratio. I would say on a safer end, it's always a good idea to have a debt to equity ratio less than 0.5. You always want to be in a situation where you have enough assets and enough capital to cover your debt. You don't want to be in a situation where you have a very high debt to equity ratio in case you are in a financially distressed position and you have to essentially pay off that debt. So to play it safe, always a good idea to have less than 0.5 debt to equity ratio.
Awesome. I have another question. Do you have any suggested finance investing courses for high schoolers?
Oh, you know what? I took tons of courses through Udemy. If you just search like Finance 101 or Investing 101 on Udemy, you can sign up for courses that are literally $20 to $30 and will give you the basic knowledge you need for investing. If you are interested, there are some CPA resources as well, but I think they're more for members. But if you're a high schooler, Udemy is an excellent tool, and I would also suggest LinkedIn has tons of resources. So there's a course feature on LinkedIn that you can tap into and search which courses you want to take, and it will give you a list of all those courses. And they're sometimes free and sometimes very cost effective.
Also, I'm a volunteer with Junior Achievement of Southern Alberta. So for any of you with high schoolers, Udemy, UDEMY, that's what we're looking for there, Udemy, UDEMY. Anyone with high schoolers, if you're interested in getting them into business or teaching them financial tools, things like that, Junior Achievement runs courses globally around the world in high schools and elementary schools. And the one that I'm part of where they have volunteers, and actually a lot of CPA volunteers for that matter, is the what's called the company program, where students actually get high school credits. They actually get a credit, high school credit for this, and it's integrated into the public and Catholic school systems to complete the building and creation of their own companies. So groups of high schoolers get together, and for a semester, they put together their own company. They choose what product they want to build. They elect their board of directors. They buy shares in their companies. And by the end of the program, they go out to places like Cross Iron Mills Mall, et cetera, and they try to sell their products that they've built and developed and done over the course of the program. So it teaches them a lot about business, and there's a beautiful rewards and certificate of achievement banquet, and they can get scholarships out of this program as well. So have your high schoolers check into Junior Achievement. They run all the time every year, and it's grade 10 through 12, I believe, for that program. Udemy, I'll type that in for everyone. That's and I'll put the link for that. That's great resource. Awesome. Thank you.
You're welcome. And I think LinkedIn, it's called LinkedIn Learning. That's the feature on LinkedIn if you want to access that as well.
There's a Khan Academy too. I don't know if anyone's familiar with that. So I'll type that in. Type that in for everyone as well. Lots of online learning.
Absolutely. I know Khan Academy, they used to be very much focused on the science and technology area, but more recently they've tapped into the business side. So lots of interesting accounting and finance courses on there as well.
And for the adults in the room, BDC, the Business Development Bank of Canada, go into the Entrepreneur's Toolkit, tons of financial courses and information there as well.
All right, are we ready to move on, Linda, or is there any more questions?
I think we're done.
Okay, so let's take this exercise, interesting exercise, so asks you to link the description with the key numbers and ratios. And so the first one, a listing of invoiced amounts per customer/client according to how old they are. And so I would say that would be your accounts receivable aging. So we touched on how the aging schedule sort of categorizes your aged invoices by 30 to 60, 90, and so on and so forth, days of buckets. The second one is current assets divided by current liabilities. We talked about current ratio. So that would be number 5. The amounts of total debt divided by total equity on the balance sheet at a point in time. That would be your debt to equity ratio. So a lot of these sort of statements are self-explanatory, just the way they list out the key terms, and you can really deduct which key terms they are associated with. The amount left after you take off all the expenses from the gross profit margin, you have your net income before tax. the amount you billed your clients excluding taxes, your revenue and your sales. And lastly, the ratio of sales less the cost of sales compared to the revenue. That would be your gross profit margin. Okay, so I'm not sure if we have time to go through the case study. There is a case study that I wanted to touch on, and it will require some work, maybe a few minutes to touch on. So I'm not sure, Linda, what do you think? Is it okay to skip over this and we can continue with our presentation?
I agree. I think the presentation and people can read through the case study.
Yes, perfect. Sounds good. So I'll skip over some of these key points here and we'll carry on to tax strategies, which is an important topic. So let's talk about tax and effective tax strategies. So corporate income tax rates in Canada for small businesses, those businesses that have income of less than 500,000 is about 11%, 9% federal and about 2% provincial. And these rates apply on what we call active business income to small companies. Like I said, with less than 500,000. Those companies, which many of you would fall into, have several tax strategies available to them. The first one is paying a salary. Salaries themselves are increase to the cost of the business, which allow your net income to decrease and lower your taxes. Now, of course, the salary will be taxed in your hands, but there are some benefits to paying yourself a salary. The first benefit of paying yourself a salary is that you get to earn what they call pensionable earnings. It allows you to contribute to your Canadian pension plan. The second benefit of paying yourself a salary is that you get a RRSP contribution rule, which means is that if you have salary, then you are eligible to contribute to your retirement savings plan. Now, as a business owner, you can pay yourself a salary or a dividend, and the government of Canada tries to basically equate the two in a way that you're not paying more or less taxes under either options. However, there is an optimal mix. In order to calculate that optimal mix, I would highly suggest seeking an advice of a CPA who specializes in tax and can help you find that optimal mix. Be aware of management fees. Management fees are those that you can pay yourself out. And again, it will increase expenses for the business, lowering the income, which will lower your taxes. But those management fees have to be reasonable, and they also have to be for specific work performed. One of the best tax strategies is income splitting. If you have a spouse or children who work for the business, you can actually pay them a salary. So what that does is it shifts some of the income from yourself, who could be in a higher tax payer bracket, to a lower paying taxpayer. As an example, someone earning about $90,000 pays tax at about 44%. Someone earning $20,000 pays tax at about 20%. So just by paying your spouse or child $10,000 for doing real work, your family unit could save around $2,300 worth of taxes. Income splitting from a dividend perspective. If your capital structure in your company allows it, meaning your spouse or children have shares in the company, you can pay them a dividend. Now, what that allows you to do is that for a person receiving the dividend, if they are in a lower tax bracket, let's pretend they are not making any income in the year, they could receive up to $40,000 worth of dividends, tax-free. That's tax savings. And the last part is about deferring taxes with a bonus. So what that means is the corporation can accrue a bonus or record a bonus, which is owed to you, that will increase their expenses, lower their income, which will lower taxes. The corporation has about 180 days to pay out that bonus, but you only get taxed when that bonus gets paid out. So if it gets paid out in the next year, the corporation gets the benefit of the deduction and pays a lower tax, and you are not taxed for at least a year. So how do you manage growth of your business? One of the toughest questions entrepreneurs face: when to grow your business and how to do it. The first question that you should ask yourself is whether you are ready. As part of that assessment, you should ensure that you don't take on large expansions until you feel ready. You should look to expand if you have so much business that you can't handle the demand and need more capacity, whether it's space, whether you need to hire more employees, etc. Looking further into your demand, you should determine whether it is seasonal or continuous. This will allow you to secure either seasonal resources or those more permanent in nature. Remember, it is always a good idea to focus on the bottom line. You don't want to take on additional expenses to the point where additional revenues are not sufficient to cover them. I have two suggestions for you. Firstly, develop a realistic projection, carefully factoring in revenue growth and corresponding expenses. Let's say over a 5-year period. Secondly, assess your customer list to determine whether they are risky or saturated accounts. You don't want to be in a situation where a loss of a large account puts you in a dire state while you look to secure extra resources. I would love to perhaps ask one of you to share some of your growth goals and strategies. If you don't mind, please raising your virtual hands, and Linda or myself can select one of you to share your thoughts. And it's okay if you're not comfortable sharing, but we have one participant here.
Tarina, I'll allow
Tarina.
Tarina to talk. Go ahead. Tarina, you can unmute. There you go.
Perfect. I'm doing a crazy thing in the next 2 years. I want to build a massive retreat, about 22,500 square foot building. And I'm scared as crap. So this is why I'm taking all these extra things to say that, yes, this is, I'm able to do this.
Okay, that's interesting. So, and I'm guessing the massive construction, you're looking into securing financing. You're looking into, perhaps investors. Yeah. Investors. Yeah. And potential contractors that will help you, build this infrastructure for you. No, that's great. And of course, I think one of the questions that you'll probably ask is, who would be your customers? That would be a very important question. Who would be interested in a retreat, and who would you want to sort of target from your marketing strategy or your sales strategy?
Well, I have already the current clientele. I would have 4 different districts coming in with the growth in Heartland. They have massive expansions coming up. The need for all one shop in wellness really needs to be addressed in Canada. We don't have as much of it or as convenient of it. So this is a huge growth market. If I can catch the train early enough to do it, I'm hoping that this is going to be a right avenue. I already have owners of property to build me the location. I have superintendents and construction companies already on board for it. I just need to get all the investors, and that is one thing I need to learn, is how to approach investors, how to find the right investors.
So you touched on a very interesting area, and it's a perfect segue to my next slide. So let's carry on that conversation, and I think there will be some answers to your questions in that part of the presentation. So thank you very much, Tarina, for sharing your thoughts with us.
Just before we go,
Yeah.
Maybe I'll leave this question till the end, but AK, we do have a question about the management fees, salary, and dividends. What's the difference between dividends, bonus, management, salary fees, etc.? Do you want to leave that to the end, or do you want to tackle that now?
Let's leave it to the end.
Okay.
And I think, because I think the next piece is a very important piece, and I think might touch on some of these questions. So we can leave it at the end, and I can try and address. We are sort of running a little bit short in time, so we might have a few minutes for Q&A, but I'll try and sort of speed through some of these items here. Okay. Okay. So let's talk about financing, particularly what major lenders and investors look for and what numbers they want to see. Linda, do you mind muting everyone? There's some background noise.
Let's see.
There's a way to mute.
Everyone's muted except me,
okay.
So it could be me.
Okay. All right. So the first the lenders and investors want to see is a business plan and proposals which should be able to answer the most basic questions about what is your product or your service, what value is it adding, what problem is it trying to solve, how does your product or service differ from those offered in the marketplace, how much money are you asking for, and what are you going to be using that money for? And what would be your ability to repay that debt? A good resource to learn about the types of questions asked is to watch the show Dragon's Den, which I watch quite a bit, where investors drill entrepreneurs on key areas of the business and what market they're trying to sort of enter, followed by sort of a robust negotiation to settle on some sort of an investment deal. So let's talk about the numbers bankers and investors would want to see. First thing they may want to see is a detailed list of your startup costs, including operating costs and capital items that you need, such as property, plant, and equipment. The next thing they may want to see is projections of your revenue for at least 3 to 5 years and with your gross profit margins. And thirdly, probably the most important thing they would like to see is a cash flow projection. So what is a cash on a monthly basis for the first year and for the second and third year, at least on an annual basis, so that you accept to receive, and what are some of the sources you're going to be spending your cash on. And this is very important for your bank to see and understand, your cash flow position. Make sure that your proposal answers at least the following 3 questions regarding the numbers. Sales, how are the numbers projected? Are they reasonable? Are they supportable? Do you have any quantifiable evidence to support the numbers that you have projected? Equity, where is your equity coming from? What sources? And loans, how much and for what period you're asking for. Sources of investment and financing. So the most obvious one would be the bank. So the bank would probably want to look at your business plan and proposal, including your cash flow projections. But one of the things your bank may want as well is some involvement from your accountant, bookkeeper, or auditor. The first type of involvement that they may ask for is a compilation or notice to reader. What that is basically an aggregation of your numbers, in a financial statement. So an accountant can help you compile those numbers so you can reasonably present them to the bank. The second type of involvement would be a review. In this case, the bank may ask an independent auditor to come in and do a sanity check on the numbers within your company, just to make sure that they make sense, they're reasonable, and follow a credible accounting framework, such as the generally acceptable principles for private enterprises, which are private standards for private enterprises, or on very rare cases, IFRS, which is International Financial Reporting Standards. And in some cases, the bank may also ask for an audit, which is probably the highest level of involvement by an auditor, and can be quite expensive because the auditor will need to take a detailed look of your books and record of accounting, and may ask for invoices, examine property, plant and equipment, interview management, possibly the board of directors, in order to provide an opinion on your financial statements so that they're not misstated in any material ways. I would discuss with your bank the best possible option to pursue, because each of these options present different costs and efforts required. In addition to a business plan, a bank often asks for a personal guarantee to ensure that funds will be repaid. Now, the personal guarantee could be from you or a spouse or a family member. In addition, they may ask for certain collaterals, such as collateral of your house, car, or any other property, all really to manage the risk that they won't get paid. Now, private lenders. One of the best sources of capital is from private lenders, primary, friends, and family. If you have exhausted your friends and family options, you can look at venture capital, private equity companies, international trade financing companies, even equipment financing companies can help you out. And they're really good sources of financing to go to. A good source of information is Canadian Venture Capital and Private Equity Association, CVCA. You may find them using Google as a possible source of information. Lastly, crowdfunding. Crowdfunding, allows you to seek funds from the general public in an easy and efficient manner. There is a great website called Kickstarter that can help you raise funds for your particular venture.
I'm also going to put into the chat for everyone, the Government of Canada lists all the different grant, loan, tax credit programs available across Canada on its website. So I'll insert that link for folks as well into the chat box and go from there as well. What was the other link you indicated, Osman? And I'll type that in as well.
So it's called Canadian Venture, it's CVCA. Let me just see what it stands for here. So Canadian Venture Capital and Private Equity Association, CVCA.
Found it, okay.
Yes.
I'll put it in, thanks.
Perfect. All right. So I know Linda has been sharing great tools and resources with you. I have also compiled sort of a list of very useful tools and resources for you to consider and get more information on. And as a look back, if you have any questions, we can try to address them in a few minutes here. In addition to these resources, I would highly recommend going to your accounting firm, your banker, and even visiting some of the Government of Canada websites that are related to small businesses. And they can really provide some very useful information to help you grow your business. CRA website is one that I constantly reference. Great, tons of information on various tax strategies and things like that. So that's one of the areas that you can touch on as well. And so we have come to the end of our session. So at this point, I will take any questions. We have about 6 minutes left in our time here.
Okay, so one of the questions we had was, can we explain more on the management piece? So can you get both salary and management fees as an owner and potentially dividends as well? And what's the difference between a dividend and a bonus?
That's a very good question. So to answer the first part of the question, I have seen companies and entrepreneurs pay themselves all three at the same time. So you could pay yourself a salary. There could be a dividend structure within your overall compensation, as well as management fees. So salary would be, your payment for, providing a service. So if you are an entrepreneur, if you are an officer or even a part owner in the business, you are eligible to getting paid a salary. And a dividend is almost a sort of a additional payment on your investment. So for instance, if you have invested your capital into a business and you have earned a profit in a given year, now part of that profit will be used or expenses before the profits will be used to pay yourself an expense. If you have, after deducting those expenses, you have a profit, you can use part of that profit to inject back into your business. So it would be, retained earnings that you can inject back in growing your business, or you can pay part of that profit as a dividend to either yourself, if you're a solo entrepreneur, or if there are a number of shareholders within a business, you can divvy up the dividends across the board. And there, as I mentioned earlier, there are different tax strategies when it comes to your salary, when it comes to your dividends. So depending on what strategy you want to sort of incorporate, you would have to decide what the mix, the optimal mix would be in terms of paying yourself a salary or a dividend. Management fees is, and again, it's a little bit of a fine line. It's really the fees that you're charging for providing a very specific service within the business. So one of my clients, they were a healthcare company, and they also managed a healthcare facility. And so as part of that facility, they didn't necessarily own it. They administered that property. And so in order to provide that service, they charged a management fee, which is different from a dividend or a salary. So that on your income statement is a separate line item. So it's first you have your salaries, then you have your management fee, where you encompass all those various types of services that you're providing as part of your business model.
So let's see. I was a new company 1 year prior to COVID and succeeded with a 39% revenue increase every year since. Will investors take this into consideration? So was that an increase in revenue in terms of, were you showing retained earnings? Maybe you want to talk a little bit about that, Osman?
Sure. Yeah, and that's a very important question to ask, and absolutely investors will look at your year-over-year revenue growth. Typically, investors look at this account called EBITDA, which I had mentioned earlier in my presentation, which essentially factors in not only just your revenue growth, but also your expense growth. There's more of a focus on your bottom line in terms of the growth than just your top line, because you could be in a situation where you have high levels of revenue growth, but in order to maintain that growth, you have to take on more resources, you have to buy equipment which gets depreciated, and hire staff, pay rent, all sorts of things that can be included as part of that growth. And so as an investor, you're always looking at what is that bottom line impact with the revenue growth as well as the corresponding expense. So as a business owner, it's a really good strategy to try and grow your business, but also equally focus on controlling your expenses to try and maximize your operating margins.
Something too, just to share with my experience. So I've had my own company now since 1993. So the first one I sold in 1998, and then I built another company after that, which I still have to this day. So some of the challenges that you face when you're trying to either when you're starting, the challenge you face is that anytime you're looking for financing, you don't have anything historical for a banker to look at or for a traditional lender to look at. So if you're brand new and you're under a year old, you're really signing personal guarantees on personal loans and using personal lines of credit and friends and family money and whatever sort of bits and pieces you can piece together to generate sort of that kickstart to your startup. Unless you're in a tech kind of business where you've got venture investors who are looking to see extraordinary growth in short periods of time, that's traditionally now what you're looking at as a traditional small business owner. If you're purchasing buildings and property and things like that, the lenders can put liens on your assets. So they're really at that point not lending necessarily to you, but they're lending based on what they could get out of the assets if anything ever went wrong. So there are programs. You can check in with your own account manager at your own bank about the financing programs available if you're purchasing property and buildings, because there is the what is that called, Osman? The small business financing program for purchasing, commercial real estate and real estate investing.
I can't seem to recall. You're talking about like leaseholds?
Well, I know that BDC does it as well. If you're purchasing commercial property, the government of Canada will back those mortgages and back those loans. You do tend to have a lot of money down on it.
Yes.
You've got to get about 35 to 40% down, but then you get those types of mortgages. So one of the helpful people that a lot of people don't reach out to if you're a business owner is your own commercial bank account manager. Sit down with your account manager at whatever bank you're using and say, tell me about the programs and how they work. And based on who I am, I'm a female entrepreneur, an Indigenous entrepreneur, I'm a youth entrepreneur. What kinds of programs are out there for me? Because there's programs for different types of entrepreneurs that might have some funds and resources for you. So there's those options as well. As well as Business Link, that's what we're here for. We're also here to help guide you to all of those types of resources to put on programs like this and webinars such as this one. We're also able, if you look on our website, we've got short videos. We have workshops, virtual workshops coming up on business planning, market research, all of the fundamental things you need to know to move your business forward. So do check out our website. Sign up for our newsletter. I've put the information for CPA Alberta into the chat as well for everyone, so that you've got that information. And let's have a final question because I've been doing all the talking. So Osman, do you have one more minute?
I do have one comment which might be helpful here. I did recently follow the Business Link Instagram page. So do follow them if you are on Instagram. There's tons of resources and really interesting posts that can be a value add for you as well if you're an entrepreneur looking to grow your business.
Nice, thank you. Final question before we go is, I put money into the company during COVID. How is it best to be paid back, shareholder loan or dividend?
Ooh, that's an interesting question. I think it would really depend on how you want to sort of maximize your tax strategies. There are some tax strategies if you pay yourself dividends, especially you can sort of depending on how you invested into the business, if you used your TFSA account, all those things sort of factor in if you are looking to sort of use your payment a little bit more efficiently and try and pay less taxes. Shareholder loans, you can pay yourself, and typically, it really depends what was the loan, what's the loan structure like. Are you paying yourself as a if you invested the money initially, was it as a loan? And so are you just simply reverting it back to yourself? So there are some intricacies in determining whether you want to pay yourself as a dividend or through a shareholder loan. I would say that either one of those strategies have benefits, and there are some limitations as well. So what I would suggest is speaking to your tax accountant, a CPA, and they will be able to sort of give you more sort of direct, more specific advice, how you want to sort of take that money out of your business. The third strategy, which may be of consideration, would be retaining that income and investing that income back into your business. There are some benefits of doing that. So, number of options for you, really, in terms of how you want to sort of utilize those funds. And I think it would be good to have an expert sort of provide more feedback to you.
Thank you so much. You have been a wealth of material today. That was a lot to cover. Thank you. I appreciate you taking the time to do that. What I'm going to do now is I'm going to stop the recording and let folks hang on to the line for about 2 more minutes. If you want to scroll up in the chat and grab any links that you wanted to grab before we sign off, I'll allow another minute after I stop the recording for that. Osmond, thank you so much for joining us today and all the great material. I'll reach out to you after the webinar this week and just say hello and send you a follow-up for that. I appreciate everyone joining and taking the time and staying a few minutes longer today. I've put a link to our survey, so if you want to provide us with some feedback on this particular presentation, we'd love to hear from you. It helps us improve, and it helps us keep on bringing resources to you. So thank you everyone for attending. I'll leave this open after I stop the recording for 1 more minute so you can grab some links from chat. Thanks so much. Take care.
Thank you, everyone. Take care.